Welcome, advanced investors. Today I'm just going to do an FOMC recap, so it's not our normal Monday thing because it's not really Monday anyway. And plus I'm sick of giving NVIDIA updates. So those might go from weekly to monthly, but I'm not getting out of that swing. Anyway, here, that's not what I'm wanting to talk about today. I want to talk about the FOMC meeting that's tomorrow. Obviously it started today, but tomorrow is really when when they come out and give their speech, and then which is almost always, I mean, every word gets analyzed in it, and it's almost the same every time. It's amazing to me how we hang on their words. But I get it. It's an important decision. What I find more interesting is always the presser afterwards. So if you have a chance, and maybe I can find a YouTube link. I'll try to add it on the bottom of this. But you can watch the presser, which is the press conference with Jerome Powell, and that is definitely where you'll get to see the fireworks. And if he stumbles on his words or yada yada yada, the wrong questions are asked, or sometimes the right ones, we see the impact. And really why we're concerned about the FOMC meeting is they dictate the rate hikes. And when I say that, what I mean is they dictate the amount of interest we're going to pay to borrow things in the future indirectly. So they loan the money to the banks at a certain percent, the banks loan the money to us at a certain percent, and in the big circle of things that if you think just for a minute about it, you can understand why some of these banks have failed, and I'll explain that quickly. So when the Fed started their rate hiking cycle, a year ago or whatever, a long time ago, it's the most, I believe, in history. If not, it's right up there. Month after month after month. What people don't understand is it takes months for that to actually go from, we raised the interest rate at a federal level, which now has to bleed into a bank level, which then has to bleed into a lending level. And remember, lending is a competitive industry. It's capitalism. So banks compete against each other with rates. So what happens is when they keep increasing all these short-term rates so much, and the banks borrow short and loan long, all of a sudden they end up upside down in these loans. They're borrowing out. For example, I have multiple mortgages that I borrowed out, commercial mortgages. When I watched the 10-year hit the bottom, which is a good indicator, by the way, watched it go, I got like 3.25% interest on a commercial rate. You go, well, Craig, I got 199 or 169 a few years ago on a balloon on my house. Yeah, I'm talking a 10-1 arm on a commercial building. And why would I sell that? Actually, I did sell a couple just because the prices of buildings are so high. But the truth is that I gotta mute this. You guys probably, I think I muted the audio, but I love this financial juice. It just makes too much noise. Anyway, back to what I was talking about was the FOMC meeting and how important it is, and I'm spending a little too much time just explaining it. What I do want to get into is how do they decide if they're going to hike, drop it, raise it? What is it? Is it because they hate the stock market? No, they have a dual mandate, which is keep unemployment reasonable. Unemployment's at record lows. Here in Wisconsin, where I live, we're literally at 2.7%. It's never been lower. Nationally, I believe we're right around the 3.5, 3.6%. Record lows, right? So unemployment's super low, so they're doing well on that mandate. The other one is price stability. Price stability means, we got to keep things working in the market and all this sort of stuff. The banking thing's a good... It's involved, let's put it that way. That's why you see Treasurer Yellen get involved and start bailing the banks out again, because they really took way too much risk. And it's funny when you think of a lending institution, because when they do your application to borrow money, it's all about risk management and mitigation. But yet when they do it, I guess it's okay to just whatever. And this is one of the problems, and I don't want to get political here, but one of the problems with rolling back like the Dodd-Frank rules, where remember the 2007-8 crisis? Some of you remember. I remember. I wasn't really an investor at the time, but I sure knew it was hard to get a house. Houses were really cheap, but they were hard to get. It was hard to have a job. Anyway, So let me jump into that. Let's take a look at our screen here. What I want to show you first is our current forecast. This is the CME forecast for the hike that's for tomorrow. And what that is right here. Let me see if I can get my little pin to work. So what they're saying is there's a 91.5% chance that tomorrow we're going to raise rates at a federal level, which is, again, the banks borrow at this level, by 25 basis points. That's been pretty well telegraphed for a while now. I don't think I need to talk a lot about that. But one of the members of the group, one of the chat groups I'm in, that I moderate actually, said, let's start, since we know it, let's start looking out to June. And it was a fantastic idea. So what I started doing is looking out to June here, and you can see, yeah, it's pretty baked in that we're going to get the, this is really May, right? This is tomorrow. All right, so June is really a ball about this, okay? A little bit about this. So there's some people out there, and this is based on analysts, by the way, analyst surveys. So 3.9% of analysts think by June, the June meeting, which is June 14th, just so we're clear, they think there's actually still not going to be any increases at all. Where 68.5% majority think that we will have in June only a 25% increase yet, 25 basis point increase yet. But what I've been watching grow, and this was almost flatline like this, but to this, again, we're looking at the June, not tomorrow, we're looking at 1 month out. Go up to 27.6. I see this hit 30. I think tomorrow we'll see some volatility in these numbers. So I guess my point is, the more they increase the rates, the harder it is to borrow money. And that's not just for you and me with our cars or our houses. That means corporations. That means borrowing money to innovate, to grow. And that's why growth stocks get hit so hard as these rates go up. So I would expect if they do come out hawkish tomorrow, we're going to see some pullback in the markets. Okay. One more thing on this chart, and then I'm going to move on into some other stuff. So I also like the CME. You can use it for one thing. I'll just show you for fun. Is you can do a compare. I wish it would show the percents at top, but if you mouse over it, you can see. Okay, yesterday let's look at the one we cared most about. 27.56% will get 225 hikes in the next two meetings. Yesterday it was 27.69. Okay. A week ago it was 8%, and that's what I'm saying. Remember how I said it was flatlined like this side? So the trend is up. The other part I want to show you about this, if you click on the probabilities, this is the rate hiking probabilities. Let me zoom into this a little bit. Of by date, meeting date, where we will be, and the chances of a hike. Okay. So you can see right now they're 94.5% chance of a hike to the 500, 525 range. Then it looks like a pause, right? Which I personally think we need to pause, going back to my point earlier that these take time to bake into the market. You don't just, it's not your Apple iPhone where you click raise click it, and then everybody's car interest rates and house rates and borrow. It takes a while. So if you look back in the history of these hikes, we've had a lot in a short period of time, and I don't think they've all baked in. We're just starting to feel the banks crack, and I think a pause would be wise. That's why I don't like seeing what we looked at with this compare chart, the current chart for June. I do not like seeing this because I think it's premature, finally. And I've been saying raise hike. I've actually even said do 100 points early in the hiking cycle, which I still think would have been smart. So at this point, the interesting part of this chart, though, is the meeting probabilities. Look what they're saying in the future. As soon as November, they're pricing in rate cuts. And I mean, it's straight down and like over 25 basis points we get to, a year from this fall. I don't think that's likely. Until we start seeing some of the wage price spiral come down and core inflation come down. I don't see the Feds just going loose and letting nuts unless A, we get into a full-blown recession, which is very possible if they don't pay that debt ceiling. And I'm not picking a political stripe here. I'm just telling you, if they don't figure that out, take a look at 2011. They actually did figure it out, but it came too close and it rocked the markets hard more than once. We're already there. It's a month away. They saw they moved up the X date because you never know for sure what day it is, but they moved up the guesstimate to that to be June 6th. I mean, that's a month from now. So we're probably going to feel damage from that unless they fix it like this week, which I don't see happening. So maybe this is analysts are pricing in a recession. The other thing would be maybe things aren't as bad as we think, and unemployment stays low. Inflation starts to come down, and we can start reducing rates and letting growth grow again. Because at the end of the day, when you reduce rates, growth companies like tech companies, especially the high beta companies, will grow. Okay. So that was a lot to swallow. I hope I'm keeping up. Everybody's keeping up with me. We're already 11 minutes into this. That being said, I'm going to bounce into, let's take a look at the economic calendar. This one I might have to zoom you in around and whatnot, but really, we had a pretty boring Monday, some PMI stuff, ISM stuff. It really didn't do much. We'll jump to a chart here shortly. Today, the big one I see is this JOLTS. I really, normally I wouldn't say it so much, but JOLTS last week made a big difference, and that's because it's reporting jobs, which goes back to my earlier conversation about if jobs get worse, more people lose their job and can't get jobs, that's actually good for the economy, as odd as that sounds. And the main reason is it's just too easy to get a job. It's still, there's 1.7 jobs available for every person looking. So we need to get that into an equilibrium. I'm not trying to be anti-jobs and people should be laid off. We're out of an equilibrium. So hopefully that makes a little bit of sense to some of us anyway. So after that, of course, we get into Wednesday tomorrow, and this is why I'm doing this today, because I want to make sure I beat this. So we got a ton of stuff going on tomorrow. ADP employment report. I tend to believe those more than the Fed ones. I'll leave out why here, but federally generated reports by appointed people or people hired by appointed people tend to say what they want them to. My opinion only. ADP, I think, is a little bit more independent. They're a big payroll provider. They got this Treasury refunding announcement. I don't think that's as big as they made it a little red one. PMI composite. Well, these will make some differences, but at the end of the day, everybody's waiting on this, and even more so. Let me erase all that because I got too much going on. It's this press conference. The tape will move a little bit on this, but this press conference is when they try to trip up Powell and get him to talk about things he shouldn't, and he tends to lean into that a little bit. Sometimes I'm proud of him, other times I'm not. That being said, Thursday, look at what we're following up. Jobless claims, big, important one. Employment situation Friday. Now that's after they made the decision, but it'll be a precursor as to what's going to happen on that June meeting, which right now, the June meeting is more important than tomorrow. Tomorrow's only, we know they're going to raise 25 basis points. Let's just say that. But what we don't know is what they're going to say about the June meeting. And then we get data right after that Thursday and Friday that's going to talk about that June meeting. So that's going to be exciting. It really is. That being said, let me just, whoops, I'm still drawing with my subscription came due on this too. They went $25 a year for me just to draw on my screen. We'll see. I'm guessing that's going to be a no. I'll find a different way. Anyway, I digress. So, hey, what? Guess what? We've hit the JOLTS. Let's see if we got numbers on JOLTS yet. All right, JOLTS opening. Forecast 9.7, actual 9.59. Okay, so down a little bit. JOLTS job quits. 4 million was estimated, a little bit less. So is that a big wash? I think this number is what matters. They're saying 9.6 compared to forecasted 9.7 and a consistent. So it's going down. The amount of job openings, 9.947. That was last month. 9.59 this month. So I think that's good news. People are be like, you're so mean, you people losing their jobs, you like it. Nah, again, we got to bring things into equilibrium. So, well, interesting to have that just happen. Same thing I'll say here, fear and greed indicator. Starting to slip out of greed. It bumped right back in when we had that last run up in the markets. Now we're getting on the edge. I think this is the nervousness before the FOMC meeting. That's more of a daily if I look at... well, here's an interesting one. Let's look at year-to-date on the sectors. Look at this. Wow, communication services just crushing it, man. Right? Consumer discretionary, not bad. I mean, it's hard to even complain about consumer staples. Industrials, materials, look at that, still going up. Real estate, everybody said that's over with. Still going up. Technology. Oh, high beta names will never go up. Yeah, they did. Utilities. My little buddy, I like to call it because it's kind of my safety play. I'll take down 2%. And honestly, if you look at the rest of these, for year to date, not too bad. The S&P up. I mean, come on. That's pretty good. Pretty good. Hard to complain about that. Compared to last year, especially. The other thing I like to do, oops, I'm still drawing on this stupid thing, is look quickly at the heat map. Let's see if this thing lit up. Okay, so this is today. Let's look for a 1 year back. Let's look at 1 year performance. Oops, no, year to date. We want year to date. Year to date. Okay, look at this. Redunculous. Here's my mistake with Tesla. 33 year to date. Amazon 22, Google 20, Meta 100%. Come on, Facebook. Does anybody even use that anymore? Microsoft. I think they're worth it. Apple. I like Apple. Nvidia. No. Actually, I was complaining about Tesla. I don't matter. I got out of that swing, so I'm gonna not complain about Tesla anymore. But I will complain about Nvidia. But if you look, it's all these mega caps that everybody rotated into from the beginning of the year. So you can say it's because of tech racks or whatever, but the truth is these have the largest, overall capital, safest play. I think you have a mix in there. Are people buying them for their growth? I think some are, but I don't think too many. I don't see growth when we have those Fed cuts that I keep talking about. So. So that's kind of what I wanted to talk really quick about that. We talked about this. No, I won't even get into that. Oh, look at today. Well, I guess the SPY didn't like the JOLTS number, huh? I told you the market would react to this. So, yeah, I got to do something just because of... you guys just got to tolerate this because I want to see where I'm looking at. NVIDIA. Why isn't my stuff... Look at this. Whoa, yeah, buddy! Yeah, because I'm shorting NVIDIA. I don't like seeing the rest of the market go. Anyway, another thing I like to look at is the IEF LQD, and this is financial conditions. Look at they're easing as they go up. It started to flag. I hate to say that's a bull flag. I think it's just things are turning around. I overlay this with the S&P 500, which is the blue line. You can see that turn into worm. Well, as financial conditions go down, we're going to see that. Another one I like to look at is credit spreads. I don't think this one moved a lot. No, it did. It's turning down too. Credit spreads the same thing. So that's bad news. Let's take a look at... Let's look at the SPY. All right. This is generally what we look at on a weekly. I'm trying to make this fast. Sorry, I know I'm getting up to my 20 minutes. Again, if you remember how I do this, this is the pre-COVID trend line, the big white line. Then I fib it back. This is a monthly chart. So remember, it takes a long time to turn a monthly chart. It's like a battleship in the water. But look we've had a run up. Now, this is May. We're only 2 days into it, so don't read too far into that red candle. But if you look, 1, 3, 4, out of the last 4 months, actually out of the last 7, we really only had 2 negative months. So I look at this and go, the MACD, first of all, it's above the histogram, and the MACD looks like it's going to cross the signal up. This is running Midland and could go either way. overall, on a monthly, this looks bullish to me. And so when I say a monthly looks bullish, that means in the next 6 months, I think you might be surprised. Now, can that change? Sure. Does it change fast? Usually not on a monthly. So the next thing then was we drill into a weekly. An interesting pattern. I changed this one. Again, big white line pre-COVID. Fibbed it out. Okay, we watched it come right back to the 50% in October. Should have bought more then. And then it raced up. I also have an anchored VWAP, by the way, on the beginning of the year. So you get above that, that means you're doing well. If you bought, above that, then I believe that's the, maybe I'm not describing that well. Anyway, you want to be above the anchored VWAP. And we are. And so what I see here now is a big triangle. And this is a bullish triangle. That's what I put it in green. So again, I look at the RSI and it's going up. I look at the MACD. Maybe that's overextended. But this pattern looks like it might want to break out. You see I noted the X date and the Powell howl. I call it the Powell howl when Powell has his presser. So that's on a weekly. We drop down to a daily and say, what's been happening on a daily, Greg? Well, again, I'll zoom way out. I got the same kind of channels. There's way too much stuff going on in this chart because this is my working chart I actually trade off of. But you can see I notate every day of importance on here. One thing to say is, man, Thursday and Friday we ripped right out. Now, yesterday we broke out of this bull flag on a daily on the SPY and then pulled right back into it. And today obviously looks like a lot of selling pressure. So, again, we look at the 5-minute today, and it's not something I normally get into on this video, but I also like looking at the ES because a lot of people trade these futures. So, there we go. NVDS, and this is just for fun, and we're going to flip it to a 5-minute. So NVDS is the inverse fund to NVIDIA, and it's a negative 1.25. Right here's where I got to get back to. How far am I? Oh, 10%. But again, it's 1.25, so that's really probably like 7-8%. Plus NVIDIA went up, 3 point something yesterday. It is a volatile equity, so I'm not happy, but I'm not going to fight with it either. I'm not going to bail out because of frustration or anything like that. Let me see if I have anything quickly otherwise I'd like to point out. On daily rundowns, I do stuff like Kospi and the DAX and stuff like that. The dollar, it's actually dropping, which is it's actually a nice tailwind to equities. The VIX, people argue the VIX is useless. I don't know. It's for sure dropped to the lowest levels since 2021, 2021. I think April even. The VIX 90 is becoming more popular, 9-day. And then we got the new VIX 1-day, which obviously I haven't spent any time on this. It has to do with the 0DTE, more ways of people to make money. I would like to look at this federal funds futures chart, and this is basically kind of a fancy way of looking at this. Oops, not that. This, but this chart, basically it's saying where are we going to end up in the rates. So this is actually tradable too, believe it or not. So what I see here is a big triangle that it has broke out, retested, and is breaking out. So maybe we do get up to 5%. I would say let's go to 485 and see where we go from there. That being said, I like to look at the growth versus value and the downtrend here because this is a ratio. That means it's leaning towards value over growth, which would make sense with the hikes, as we've talked about. Look at bonds. Bonds are down. I guess we can get into commodities and stuff. I'm not gonna for this video though. But last and most, I think it's important to look at the yield curve. The red line we inverted. So the yellow line is the day we inverted. We've been inverted for way too long. This is the 10-2. So it's the most common one you hear people talk about. Is it the best one? I don't know. This looks like a big breakdown to me. If we go down to fill this gap, I mean, it's going to be hard to avoid a recession. The 10-3 month, look at my ticks are dropping. So I'll get back to what that means in a second. So the 10-3 month, look at again, inverted, when it inverted, it's just, look at it dropping today. Not good. So this tick that you just saw my alert come up, and I'll just talk about it since it popped up. What I do is, tick is the amount of cumulative buys and sells added and subtracted from each other on the New York Stock Exchange. And generally, if you get 1,000 ticks, it's often an institutional buy. And where I see that is usually around, say you're right at a resistance point and you're banging against it, some big JP Morgan says, we want it to go over that and make it support now. And they'll just throw money at it. So what happens is the ticks, the cumulative ticks will go over 1,000, and I'll consider that a buy program, and it goes the other way for under 1,000. So the alert we saw was actually for the under 1,000, which means often institutional got involved and started selling. And so what I like to do, I call it the SPY versus tick, is I follow the SPY, and then I split the screen with this tick here, which again is the cumulative tick. When it's net neutral, it means the same amount of buyers as sellers. When you start getting into sell programs, it tends to mean it's institutional level because there's so many. Oh, there we go. So JP Morgan's selling right now. I'm just kidding. I don't know who is, but somebody is. That or it's a ton of retail. Maybe the Red Wall Street bets. I'm not even sure they can make it tick, but maybe that's a whole nother video. So that's what I have really to sum up my FOMC video. Please like and subscribe if you enjoy these. I'm sure I missed some stuff. Feel free to comment. I have a lot of thoughts on this. I've cleared my calendar for tomorrow to watch, and trust me when I say I'm really mostly a long investor. Look at another downside tick. We call them 6 sell ticks, 6 buy ticks, BICs. So, but anyway, I'm a more long-term investor, so I'm watching actually to invest. So oddly, I kind of want the market to go down so I can put some dry powder to work. On the same side, I'm 50% long, so when it goes up, hard to complain about 4,200, right? When you have longs, the only one I'm stuck in is the stupid NVIDIA one, which I just do that to be in the game, honestly, and it's okay. So thanks for watching. Please like and subscribe. I know this went long. We're almost to 30 minutes, but I appreciate everybody's participation in my chat groups, the audience that watches this, and just everyone that helps mentor me through this. I've learned so much in the last 5 years, a lot from these groups that I'm involved in. And if you're interested in getting involved, please send me a direct message. I'd sure love to hear from you. We love teaching people new things. We have people that are experts in different areas, from natural gas to oil to commodities of all types. Heck, we had a wheat guy for a while, but I still look at it. I'm never going to buy wheat futures, but maybe I should. I don't know. Anyway, my point being is we have everything from Elliott wave guys to, I'm a pattern analysis guy. We've got guys that use volume shelf profiles. I can just go on and on, and so I'm proud of those guys, and I'm happy to be a part of it, and really just a moron amongst my peers there. So that being said, way too long-winded, definitely closing on 30 minutes. Hopefully somebody watches more than the first 3 minutes. All right, take care and have a great weekend. FOMC tomorrow is going to be big news. It's going to be a market mover, I promise you that. Later.